and welcome back to Real Tax Talks. This is Michael Coronado, and I have Dan Mathason, who has joined us here in the podcast studio.
Hi, everybody.
Hello. So, Dan, thanks so much for coming. I really appreciate your taking the time. Love to hear a little bit more about you and kind of what got you into real estate investment.
What I do is I bring together Bitcoin and real estate to do things that they can't do separately. A little bit about, I guess, my background, the journey to get here. I grew up in South Florida, graduated from Wharton. I was at Lehman Brothers before Lehman Brothers blew up. I was gone pretty few years before that, but I was on the institutional fixed income desk over there. And then I saw the writing on the wall that that industry was transitioning, getting more automated, it seemed like less of a career path for somebody who's in their early 20s. And I got involved in real estate while I was there, working with some of the people because they were also funding big projects. And I liked that a lot better than the fixed income end. So I ended up moving over there to investment and development. Since then, I've worked on some major projects focusing mostly on condos and hospitality. Some projects like 400 Sunny Isles, 1010 Brickell, the Harbor, Embassy Suites, St. Augustine Beach. I was involved in all of those. Um, I co-developed my most recent development project. I co-developed a wave house in Bitcoin Beach in El Salvador.
Okay.
That was a fun project and a whole podcast of stories in and of itself. But that brought me to
All right.
Bitcoin, and since then, my mind's been churning on how to kind of bring these two worlds together and make them the best combination of themselves. It's a 2 + 2 = 5 situation. And I'm now working on a project open to accredited investors, focused on cash flow tax advantages, which I'm sure you'd appreciate. Um, and that brings together the real estate while growing the Bitcoin stash. And for the Bitcoiners out there, um, you know, it, the goal is to expose your Bitcoin to no risk. It's kind of like it takes a Bitcoiner to think through the Bitcoin issues a little bit. And that's my new project. But like I said, it was really kind of the path from beginning to, every step you take takes you in a different direction. But that's how I got there, and that's where I'm at now.
That's amazing. So, you mentioned so you started kind of traditional finance and kind of worked your way into the development real estate, but it wasn't always Bitcoin
No,
related, and that's
no.
been more recent.
Yeah, that started with this project when I got into it in 2021. That's when now I knew of Bitcoin, but I really didn't understand it and embrace it
Mhm.
until I got into the world. So, like, being that it's in El Salvador, Bitcoin Beach, that project got a lot of international attention, and the president of El Salvador actually made Bitcoin a legal tender.
Mhm.
And I think that the success of that project was a lot to do with that. So it was the first country to make it Bitcoin legal tender in the country. Also, the US dollar is their other legal tender. But it was talking to the Bitcoiners who loved this area and were buying in the project and learning from them. And then that took me down what they call the rabbit hole, the orange pill rabbit hole. So you you go and listen to a lot of podcasts like this, read, understand, learn the economics of it, and it's to me it's a very beautiful and elegant system. Um, but it's one tool, right? Not everything's a hammer.
Mhm.
So like I see the beauty of it, and I see that it's not perfect. It doesn't solve every problem. So that's why my head traveled while we were working on this project on how to integrate it with other tools, to again get that amplification. 2 + 2 = 5.
Interesting. I'm not very familiar with the. I mean, recall hearing about the project in
Sure.
El Salvador, but walk us through it. So, were folks purchasing the units using Bitcoin? Were the initial investors in Bitcoin? How did?
So it's a condo project like any other condo project. You have the site and you build a building on top of it.
Mhm.
But what happens is it's done with pre-sales. So people buy their units before the project is
Mhm.
done. Most bought actually before a shovel was in the ground.
Mhm.
So what happens is you have buyers who bought with dollars and you have buyers who bought with Bitcoin. So this is something I had to solve for actually, because in the US there was a project that had taken Bitcoin for pre-construction deposits. And I had to figure out how to do that in El Salvador because A, I wanted to take care of my people who wanted to pay in Bitcoin, and B, it just made all the sense in the world because here we are in Bitcoin Beach. If you can't pay with Bitcoin here,
Mhm.
what are we even doing? A large number of my buyers were Bitcoiners, and I had some that wanted to pay exclusively or partially in Bitcoin. So, that involved figuring out, okay, well, how do we take it? What do we do to pay our bills with these people, our contractors that only want to be paid in dollars?
Mhm.
Um, how do you make sure that you're not risking anything? Because Bitcoin in and of itself, I think is beautiful in the long term, but in the short term, 1 week, 1 month, 3 months, a year, all bets are off. It could go anywhere. In the long term, it's always, if you look at any 5 year period, it's always done better than, there's never been a loss and it's always compounded amazingly. But we're not talking about a 5 year time frame, and I have a responsibility to the people that I'm building for, not to expose the project to any risk.
Mhm.
As much as I love Bitcoin, want to hold Bitcoin and and help the circular economy of Bitcoin, like I owe it to them to deliver the project. So navigating all these things and doing it in a foreign country, it was fun. It was fun to figure it all out and make it work.
So were the prices fixed in Bitcoin? Was it X number of Bitcoin when you put a deposit down on a unit, or did it fluctuate based on the dollar value of the Bitcoin?
So everything was denominated in US dollars. I think the important thing that you have to do when you have a project like this is make sure that all your costs and all your revenues are in the same currency, are in the same unit of account. So if I have the majority of my suppliers and contractors that want to get paid in US dollars, I need to have the revenue in dollars as well.
Mhm.
So there's not a mismatch. So there's not a currency risk. So what we did is everything was in dollars. So the contracts were denominated in dollars. And then when my buyers paid their deposits and paid their final payments to buy their units, we took the quote on the market right then and gave them the spot rate. So they paid in dollar terms everything that they were supposed to pay pursuant to their contract, but they paid it actually with Bitcoin.
And they paid it based on the value at closing, not the value. So if I put a deposit down today and I close in a year, I paid it. It was based on the value in a year when I closed. Is that?
Well, there are a million ways
Yeah.
to do things, but how we did it to make sure that the project was not exposed to any of this is whenever that payment was due, the payment is denominated in dollars in the contract, and it's the amount of Bitcoin that it would take to deliver those dollars to the project at the time the payment was made. So, for example, the contract says $800,000.
Mhm.
So if you make multiple deposits payments along the way based on the amount of project progress that has happened. So you break ground, that's a deposit. You sign your contract, that's a deposit. Um, Flip the order of those,
Yeah.
obviously. And the project tops off,
Yeah.
that's a deposit. When the project is done and you're ready to take the keys, then you pay the final balance. All of those are different moments in time. So it would be US dollars are owed at that time, and you can pay the Bitcoin that would equate to that number of dollars at the time that that money was due.
Wow, interesting. And so how so you took the lessons learned from that project, and now
Yes.
you have this upcoming project, and how are you taking the lessons learned from that and kind of making the 2 + 2 = 5?
Well, I mean, it's not just about repeating the same thing. It's about I built my new project with Bitcoin principles, so going from the ground up. I think that really smartly integrating them strategically is what is required to make 2 + 2 = 5. So part of it is that Bitcoin is an amazing instrument. It's I honestly feel that it is the asymmetric opportunity of our generation. That and AI arguably are the top two. And so what happens is between this amazing opportunity, you have the ability to take savings and convert it into something that relative to the dollar, relative to buying power, um, can do amazing. It has fixed supply. It is increasing demand, asymmetric opportunity. It's scarce and desirable. These are amazing aspects and the foundation for a very strong investment. There are
Mhm.
other investments that are strong, but those qualities make it a very strong investment. But you have to be able to hold it. So when people talk about volatility of Bitcoin, what they're talking about is relative to something.
Mhm.
So it's not like one Bitcoin is one Bitcoin, but one Bitcoin relative to how many US dollars it is, or the basket of goods and services that you can buy with it. That changes dramatically because it's an immature asset. An asset like this takes, and new financial systems historically have taken decades and decades to be adopted. And Bitcoin is very early in that cycle. So you expect volatility because it's not a quote unquote mature asset yet. But that volatility is hard. It's hard to handle psychologically. So an investor has a hard time, going through these swings and a 50% drawdown, a 70% drawdown. Oh my God, this is going to zero. What can I do? And then the you sell at the exact worst time
Mhm.
because that's psychology. That's human psychology. Not everyone, but a lot of people have done that. Or that that's the fear side. The greed side is, wow, I doubled my money in 6 months, and they take it off the table, and then they don't get back in until it's tripled. And if they do again, because it feels expensive, because like, wow, I bought this thing at $100, like now it's $4,000, like it's super expensive. But that's psychology. So the thing that helps somebody stay through the volatility of price because it's a maturing asset, and some that helps people put it away. Like I advocate there are many ways to approach it, and everybody has a different situation, so different things work for different people. But the way I approach it is I think the best thing to do is have an income source and another investment that's an asymmetric opportunity. And by that I mean it has it has the potential to give a lot of return for the amount of risk you're taking.
Mhm.
So if you've got two things that have the same amount of risk, but one could 5x your money, and the other one probably in most cases is going to give you a nice consistent little return. Okay, which one do you choose? You choose the best thing to do, I think, is actually to choose several that have the opportunity to have that asymmetrical risk. So how many times do you have to multiply your money by five to outpace that one that only gives you that slow return per year? So with Bitcoin, you have that asymmetric opportunity. And if you have something that can give you the ability psychologically and in the real world to hold your money and not have to touch that Bitcoin, not have to think about it, not have to borrow against it,
Mhm.
risk it, do any of that to fund your life, cash flow, right? If you can solve for that and both are asymmetric opportunities, and now I think you're in a great place. So that's why I think that the answer for not everybody, but for a lot of people, is to bring together real estate and Bitcoin, because Bitcoin is, to me, an amazing asset in and of itself. But it, if you don't solve your cash flow, then how do you hold it when it goes down 50%? How do you have that that psychological fortitude to make that happen? How do you have a stress-free life if you're watching that price every day and it bumps up 5%, down 5%, 10%, 15%, 20% from the high? And so if you have the cash flow solved and you're not increasing debt over time and then having compound interest work against you, like some people borrow against their Bitcoin. It's like, say, okay, I feel safe taking a 10, 20, 30% loan to value loan against it. And then, okay, well, the interest right now is 10, 13, 14%, which to me seems ridiculous for collateral that somebody could liquidate in 10 seconds in a very liquid market. It just seems ridiculous to me. But that's the rules of the game right now. If you're doing that, then you have compound interest working against you. So how are you going to fund those debt payments? Well, okay, that 20% loan creeps up to 22%, then the next year 25% because of compound interest, and eventually you have a drawdown which gets real close to that. So, uh, to wrap up a long-winded answer to the question, if you have cash flowing real estate, income real estate that has enough cash flow to you so that you don't have to touch that Bitcoin. You take that hardware wallet, you put it in a safe deposit box, you never touch it, you never think about it, you let it do its thing, because over that 5-10 year time frame, it's always done amazing. And if you believe in the thesis of it, and it's not just Bitcoin, this would be for any kind of investment that doesn't have cash flow along the way, particularly if it's something that's liquid, that you could go to the market and sell that stock. Or if you SpaceX is coming up. If you believe in SpaceX over a period of 5, 10, 20 years, you think that's an amazing opportunity. You want to have the ability to leave it alone, let it do its thing.
Which is hard.
Which is hard psychologically and in the real world, because you have bills every month. We all do. So, if you have an income source that's stable, reliable, growing, because inflation is a factor, that's good. But income real estate is a way to do that as well. And it also is the most tax advantaged investment in the US, I think, by far. You're the tax man, you tell me.
Yeah, no, definitely that's one of the places that makes a lot of sense.
So if you have a good market that's growing, and you have an opportunity that you see upside in that asymmetric risk, because it is a growing market, and you see the cash flow and potential for that cash flow to grow, which grows the value of the investment, and you take advantage of bonus depreciation. So depending on how the asset's structured, in every situation is different, but you can potentially get tax-free income from that investment every year until you sell it. And that when the depreciation gets recaptured, okay, so you never escape the tax man forever, but you can
You're delaying it.
you can delay it significantly, let your money grow in that time, and by the way, probably pay capital gains tax rates, long-term capital gains tax rates,
which are lower than typical, the higher end of the table.
So use all the tools that are in your tool chest, use all the advantages that are out there. I mean, that's what I think a good investor does, is use all the tools that are available to take risk off the table and to build something that does what you need it to do. So, the difference between the return of a lottery ticket and, say, income real estate, the lottery ticket returns much more, but what are your chances of it working out? Very slim. So go for something that de-risks, that has structural advantages. You want to be the house. You want to be the casino. You don't want to be the person walking in there with no plan. You always want to have a plan, and you always want to understand the tools at your disposal and make sure that the investment is a good fit for you and your goals.
And so is the idea to I get it, right? Bitcoin, get income out of it so that you're not worried about the fluctuations in value, which is actually the same thing even in real estate. Because in real estate, if you're cash flowing positively, I mean, you are concerned about the value, but if you're making money every month, you're not as concerned about, what is the market, what was the last building or property that sold near me? Oh, it's, $10,000 less than I thought, or, where I thought we would be headed. So your idea, however, is to do this using leveraging the Bitcoin to do the real estate. Is that?
Okay, so let me go back a step. So there are different ways to structure a portfolio, and diversification is a concept as well. So you want to build something, just speaking generally, not just Bitcoin real estate. You want to structure something that takes as much risk off the table as you can and that fits your goals. So to me, Bitcoin and real estate work together because Bitcoin doesn't give cash flow,
Mhm.
but it's an amazing opportunity. So what allows you to let that opportunity play out? Because
Mhm.
it's going to take a long time to play out. So 5 years minimum, to feel comfortable based on historic trends that you're going to be positive versus the dollar value of that Bitcoin. And the longer you hold it, the longer that thesis plays out. And if you're committed to the idea of the asset, so whether it's Bitcoin, SpaceX,
Mhm.
or whatever your investment is, then you got to give it time to reach its goals. But if you have the other needs that you have covered, so if real
Mhm.
estate covers your cash flow need, then it's a lot easier to leave the other part of your portfolio alone so that it can do its thing. So by having income real estate, you have something that for a Bitcoiner is very attractive, right? Because it shares a lot of properties. So income real estate, it's limited in supply. Um, you not everything is desirable, but you can focus on desirable real
Mhm.
estate. You can look for opportunities that have an asymmetrical advantage, so that reward versus the risk, it, you're getting a lot of reward for the risk you're taking. And that cash flow lets you leave the other things alone so it can do its thing. So the diversification piece comes in because you want things that don't move at the same time in the same direction. Correlation, right?
Mhm.
You don't want things that are overly correlated because then you're not really diversified. So an investor wants to have multiple ways to win. That's what diversification is, multiple ways to win. So, if I have 10 things, all equal weight at the start, and some of them do great, some of them do okay, some of them do bad, then overall you're great. And if you have enough time to make that thesis work out, then you should be doing well as an investor.
So, okay. So if I'm tracking right, you're talking about invest in Bitcoin and real estate at the same time so that the income
Yes.
from the real estate gives you the cash flow you need while you allow the time that potentially Bitcoin will need in order to grow. Is
Yes.
that? Yeah,
And by the way, you're talking about the risk of real estate as well. So every investment has risk,
absolutely.
100%. And going in there, you should just understand that. But it's income real estate in and of itself has some advantages that other things don't. So it's a physical hard asset.
Mhm.
Bitcoin is a hard asset, but it's not physical. So the inherent value of that land is never going to go to zero,
Mhm.
right? So you don't have full risk on that investment. And well managed real estate that is income real estate is designed to give income. It it de-risks you by having that money over time.
Mhm.
So it's not just the beginning and the end. You have that income along the way, which buffers the end result. So you look at your series of cash flows, and you have, even if you sell at the worst time, interest rates have gone up
Mhm.
tremendously. You're a forced seller. You can't refinance. Everything goes wrong. You won't be selling that for zero, and you got some money along the way. And by the way, because it's real estate, and particularly if we're talking about the U.S., you have tax advantages along the way. You're able to deduct the cost of the interest that you've used
Mhm.
to buy that real estate. You're the just the debt in and of itself is a structural advantage because you get long-term fixed rate debt. You know exactly what your debt payment is, and you're paying it back over time with dollars that, with inflation, buy less goods and services than they did the year before. So you're giving it back with more purchasing power. So like the old story of you buy a house in 1950, what's your mortgage payment? Let's say you hold it
Yeah.
1950 to 1980. What's that principal and interest payment? A couple hundred
Yeah.
bucks.
Yeah.
Or do it to the present day, 2026. Take that back 30 years.
Yeah.
Okay, it's a couple $1,000 maybe. Obviously it depends on the house,
Yeah.
depends on the interest rate and everything, but like how easy is it to pay $1,000 versus
Oh,
at year 30 versus year one? It's just your income goes up with inflation. Hopefully it goes up with inflation. But the uh, it's a lot easier to make that payment on the end of that cycle than it is at the beginning of the cycle.
that's actually, yeah. I mean, and when I think about real estate investment, especially when it comes to like a primary residence, I tell, people are like, well, you're still paying it off. You're still making a payment, but you're basically fixing your rent. And
Well,
I know there's,
part of it,
yeah, part of it, a good
there's
chunk
the
of it.
insurance and the maintenance on
But
top of
even
that,
then,
obviously. But
but over the long term, right? You have
that's the
homestead
biggest
exemptions.
piece of it,
That's the
for
biggest
sure.
piece. And
Yeah.
so if you keep it fixed, even though if it's the same or slightly more than what a rent would be today, we know that in 10 years, rents are going to be much higher. And if you're paying about the same as you're paying now in 10 years, even if it's up, 10%, you're still paying likely much less than the rent. So it definitely it makes the sense in that long term scenario. What's interesting to me though, because I talk to a lot of different people and talk to different clients, different walks of life, I feel like there's two different types of people: people who invest in real estate, people who invest in stocks or in equities. And so it's interesting to me that very rarely do you find someone of the profile who says, I know this, I'm going to do this. I know people who've been extremely successful investing in real estate or like businesses that they've run versus going out to the stock market. How do you kind of bridge someone into uh, you should be on both sides?
Well, I would start with just taking the big picture view. There are different tools for different jobs, like we said. So if you're looking for just appreciation, there are some things that fit in that box. If you're looking for just income, there are things that are fitting in that box. If you're looking for something that is a hybrid, there are things that fit in that box. So number one, you got to start with your goals. And number two, there's an adage that um, if you want a tremendous return, then you have to focus and really be arguably over concentrated. So the person that you say that does everything in stocks, that's how they get an edge because that's what they know, that's what they understand. They concentrate, and if they hit it right, and you can't predict the future, so a lot of that is skill and luck.
Mhm.
But if the longer term you hold, the longer you have for your thesis to be right. So, like if you buy at the worst time in the stock market, which for buying would be a peak,
Mhm.
and then you let it run. Historically, if you buy a diversified portfolio, the S&P 500, you buy at the worst time, you go through pain, 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 and then it recovers because you let your long-term thesis work out. Those people do well over the long term, as long as in stocks, I think the value diversification is seen a lot more because you see that the performers in the stock market tend to be a very small number of stocks at the same time. So it's hard to pick who those are. Some traditional financial advice that I've heard is buy the SPY. the S&P 500 index. You can buy the thing, it trades like a stock, it has very low fees, and those fees, like interest, they compound. So those fees compound over time and they bite into you. So some people would say, put, I don't know, 70, 80% of your stock allocation in the SPY, and then the rest go for those moonshots that you think are asymmetric opportunities. Maybe they do great, maybe they don't. Maybe Nvidia has infinitely more gas in it. Maybe it peaked. Who knows? You find out afterwards, right? But you can, if as long as you make sure that you cap your downside and have exposure to those asymmetric winners, then you can be in a good position. So, like the SPY, I read something the other day. It's like there were 7 to 9 stocks, I think it was, that equated to all the return of the S&P 500 index over the past several years. So everybody else basically balanced out to nothing, but all the return came from a handful, a small fraction of those. So if you have exposure to the whole thing, then that helps you. And especially if that the value of the SPY, it has a lot of properties that are very useful. It's very liquid. You can get in and out. It has low fees, like we talked about. But you're not gonna kill it with the SPY. You should be able to track or beat inflation with it. So just understand what the job is that you're trying to assign to these tools. If you're trying to build an empire, that's not the tool. If you're trying to make sure that your kid's college fund is protected and you have that money around in 20 years, that thesis should play out well enough. So the shorter the time frame you're looking at, the more chaos you can see. But just going back to the overall picture is understand what you're looking to do and then build the parts from that and look for ways to build the best parts. It's like if you were going to build a custom car. It's like, okay, not everything's the engine, but you want to say, okay, I need the engine, I need the seats, I need the windshield. Let's put together a system that together works and complements itself.
Yeah. No, it makes sense to me. But I just know I hear that from a lot of people who, they're worried. They don't want to do one way or the other. And I think that a lot of times for people, the best investment advice I ever heard was, invest in what you feel comfortable putting your head down on the pillow at night. And
Right.
and different people have that different risks.
Well, again, that goes back to the psychology and having the ability, because of that psychology, to let your investment thesis work out. It's being comfortable that lets you hold for 10 years, for 15 years, for 20 years, so that investment can do what it's going to do. Because a large part of human psychology is getting trapped into being greedy when you should be fearful and being fearful when you should be greedy. It's like you see everything going up and you're like, this is going to go to the moon. Nothing goes to the moon. And when things look down, it's, oh, the world is ending. I need to get what I can get. But if you waited 3 months longer, you would have seen that recovery happen and you miss it. So being comfortable, like you said, understanding it, being comfortable helps you with that process and just understanding the tools that you're trying to apply. So keeping it focused while you're trying to build is a good way to usually reach success. But you have to have the vehicle that works for the situation. You have to have that good analysis too. But when it comes to protecting, if protecting is your goal, then you want to do a little bit more with diversification. You want to take those puzzle pieces and make them complement each other and have lots of different ways to win, knowing that you're dampening your overall result. Because if you pick that one thing that would give you the biggest return, if you pick it right, you're great. If you don't pick it right, you're not great. But when you get to the point where protection and quiet growth are more important to you, then you want to put different things in there, different eggs in that basket. so to speak.
No, absolutely. I mean, you're talking about the hyper growth. What if, Sam Walton had it continue to hammer down on Walmart, right? I mean, that was how he was able to make that.
Absolutely.
If he would have diversified, he maybe have not have grown as much as what we know today. So that does make a lot of sense. And so, kind of shifting gears back to you talked about how your new investment or opportunity. How does that work? How would folks participate in that, and how would they?
Well, the best thing to do would be get in touch with me. I think we can link it in the show notes,
Yep,
or you
yeah,
can
we'll put
look
it
me
in.
up at LinkedIn. That's an easy way to get in touch with me, but it's open to accredited investors only. So, part of what's different about different investments is some are only open to certain people. So the U.S. government, for example, to protect investors, wants to make sure that you're an accredited investor. There's another status above that, qualified, um, before you can be involved in certain investments, and that's because of the nature of the investment. So, like, I'm working on something for accredited investors. It's not a good fit for everybody, but I'm very excited about it personally. So, but the that doesn't mean not to look to invest, not to put away, even if it's a small part, because in the age of uh, brokerage accounts with zero commissions, you can buy a small bit of SPY.
Mhm.
You can have diversification and be able to build and start working on the long term and put a little bit away every single month, and that grows tremendously. The math is there, and there have been some very interesting articles written about this on how even starting with a very modest amount, but giving it the time to run. So starting when you're 15 years old and then going to 65 years old, starting with a modest amount versus large amounts later, that person that waits never catches up, and that's the power of compound interest.
Yep, I was gonna say power compounding.
The
Yeah,
power of
that's
compound interest. Einstein has a quote, I think it was, it's the most powerful force in the universe because
yes.
people don't think in exponential terms. Like our minds are just not wired that way. But like you want to make sure to protect yourself against compounding and you want to make sure to take advantage of compounding. So, uh, these returns, reinvesting when you have returns, reinvesting so that it can get interest on interest, that over the long term is just, it almost doesn't compute in the human mind. But you also don't want to do something where you're borrowing and then, okay, you pay for that interest by taking out more loan. And then all
Yeah.
of a sudden you're upside down. And the other thing was the fees. So like the SPY. So those fees compound over time as well. It's like if you had an S&P 500 fund that gets big fees versus little fees, you look at the long-term chart of where they would be in 20, 30 years, and it's mind-blowing.
Like Berkshire Hathaway, right? That's one of the things where they say, not charging the fees has allowed them to grow.
Yeah, I mean, I'm not the best person to talk about Berkshire's business model. I haven't studied it as deeply. Everyone knows
Yeah, yeah.
Warren Buffett, but the Warren Buffett has done. I was actually listening to a podcast about him, and it was in the last 10, 20 years of his career, he did multiples of what he did in the first multiple decades. And that's the power of compound interest. So I can't really comment on what they did structurally as a company, but like
Not
it's
charging the
just
fees. That's what they would have stunted the growth had they charged those same fees was the kind of the premise.
right. Um, which makes sense if you have a low, I mean, if they're in a diversified investment vehicle that has low fees and their principals are making their money by the stock appreciation, I think they did okay. But at the same time, it's allowing those investments to compound that got
Mhm.
that made Warren Buffett Warren Buffett.
Mhm. That's I think maybe what we should all strive for is our version of that of allowing that compounding to occur. Well, Dan, I wanted to thank you so much for joining me today. It's been a true pleasure, and we'll be sure to post the link for your enterprise as well. And so folks, if they're interested, can find out more. And if you want more information on real estate investment and tax advisory for that and what to do, you can reach out to me as well. Thanks so much.
Okay, thank you.
Thank you.